Your mortgage rate is not set by your bank, not really. It's set in rooms you'll never see, by people you'll never meet, reacting to forces you'll never feel directly. And a tiny shift in that system can quietly add or subtract hundreds of thousands from your life. Here's the uncomfortable truth. Interest rates are not just prices for money, they are levers of power. And your mortgage is one of the cleanest ways that power shows up in your kitchen, your bedroom, your future. Let's start with a simple story. Two people buy the same house, same price, same down payment, same neighborhood. One buys in 2021, the other buys in 2024. The first locks in a 3% mortgage. The second faces 7%. Same house, same bank, completely different lives. One pays hundreds of thousands less over 30 years. The other funds a quiet transfer of wealth to lenders, bondholders, and the financial system. That difference didn't come from the bank manager. It came from the hidden game behind interest rates. So what is interest, really? At the surface, it's the price of borrowing money. You borrow today, you pay back more tomorrow. But interest is also a signal, a brake, a gas pedal, a weapon. It controls how fast an economy moves, how risky people feel, how expensive homes become, how fragile debt piles grow. To understand your mortgage, you have to zoom out, far out, because your mortgage rate is chained to a global system that starts with central banks. Think of a central bank as the thermostat of the economy. Too hot? Inflation rises, prices explode, currencies weaken. Too cold? Businesses freeze, people stop borrowing, recessions deepen. So, central banks adjust interest rates. When inflation rises, they raise rates to slow spending. When recessions hit, they cut rates to stimulate borrowing. This sounds technical. It is personal, because mortgage rates follow this signal. Not instantly, not perfectly, but relentlessly. Now, here's where the hidden game begins. Banks don't set mortgage rates based on your personal story. They borrow money themselves, from deposits, from bond markets, from global investors. Your mortgage rate is built on top of a base rate, plus risk, plus profit. It's a stack. At the bottom is the central bank policy rate. On top of that is the bond market rate, especially government bonds. Then the bank adds risk premiums, then your personal credit risk, then profit. You don't see the stack. You see the final number. But every layer moves. And when the bottom layer shifts, everything above it shakes. Now, let's talk about the bond market, because this is where mortgages really get priced. When investors buy government bonds, they accept a certain yield. That yield becomes a benchmark for safe money. Banks look at that and say, if investors can earn this with zero risk, we must charge more to lend to homeowners. So when bond yields rise, mortgage rates rise, even if your bank never changed its policy. And bond yields move for reasons that have nothing to do with your street. Inflation expectations, government deficits, global capital flows, geopolitics, recessions, panic. Your mortgage is a global instrument disguised as a local loan. Now, rewind to 2020. The world shut down. Economies froze. Central banks cut rates to near zero. Governments borrowed trillions. Mortgage rates collapsed. People rushed to buy homes. Prices exploded. Not because houses got better, because money got cheaper. Now, fast forward. Inflation surged. Central banks panicked. Rates jumped. Mortgage payments doubled. Home affordability crashed. Same homes, different money conditions. This is the hidden game. Interest rates don't just affect how much you pay, they decide who can buy at all. When rates are low, investors and wealthy buyers borrow cheaply and buy assets. When rates rise, first-time buyers get locked out. Interest rates are not neutral. They shape inequality. Now, let's zoom deeper. Your mortgage is a long-duration bet. When you lock in a 30-year fixed rate, you're making a deal with the future. You're betting on inflation, policy, and economic cycles. If inflation stays high, your fixed payment becomes cheap in real terms. If inflation collapses, your payment becomes expensive. Banks know this. They hedge this. You don't. They bundle mortgages into securities. They sell them to pension funds, hedge funds, central banks. Your monthly payment flows into global capital markets. You think you're paying a bank. You're paying a system. Now, consider adjustable rate mortgages. They feel cheaper at first. They feel safe. Until rates move. Then your payment jumps, not because your bank changed its mind, but because the global cost of money changed. You are living inside a floating macroeconomic variable. Now, here's the uncomfortable part. Central banks don't care about your mortgage specifically. They care about inflation, employment, and financial stability. If inflation is high, they will raise rates even if millions of homeowners suffer. If bubbles grow, they will tighten even if housing crashes. Your mortgage is collateral damage in macro policy. And this is not a conspiracy. It's a design. Modern economies run on debt. Governments borrow. Corporations borrow. Households borrow. Low rates make debt manageable. High rates make debt painful. When debt gets too large, central banks face a dilemma: raise rates and crash the system, or keep rates low and risk inflation. This is the hidden game. Every rate decision is a trade-off between pain now and pain later, and mortgages sit right in the middle. Now think about the timeline. In the 1970s, inflation surged. Central banks raised rates to extreme levels. Mortgage rates hit double digits. Housing collapsed. Recessions followed. In the 2000s, rates stayed low. Housing boomed. Debt exploded. Then 2008 happened. In the 2010s, rates stayed near zero. Asset prices soared. Inequality widened. In the 2020s, inflation returned. Rates spiked. Affordability collapsed again. The cycle repeats. Interest rates are the rhythm of modern economies. Mortgages are the drumbeat you feel. Now let's talk about the psychological side. Low rates create euphoria. People feel rich. They borrow. They speculate. High rates create fear. People freeze. They save. They cut spending. Central banks manipulate this psychology deliberately. They use words, speeches, forecasts to shape expectations. Your mortgage is influenced by sentences spoken at press conferences. Now consider this. When rates rise, your payment rises. When rates fall, asset prices rise. Either way, you feel trapped. You either pay more for money or pay more for assets. This is the rate paradox. Interest rates are supposed to stabilize the economy, but they also trap individuals in timing lotteries. Buy at the wrong time and you lose decades of wealth. Buy at the right time and you gain it. The system rewards timing, not just effort. Now zoom out to the political layer. Low rates help governments borrow cheaply. They help stock markets. They help real estate. High rates hurt governments, markets, and voters. So rate decisions are political even when central banks claim independence. Every rate hike angers homeowners and borrowers. Every rate cut angers savers and pensioners. There is no neutral rate. Now, the deeper layer. Who actually benefits from interest? Lenders, bondholders, financial institutions. Interest is a stream of wealth from borrowers to capital owners. Mortgages are one of the largest interest pipelines in human history. Trillions flow from households to financial markets over decades. This is not a side effect. It is the core business of modern finance. Now, ask a harder question. Why does the system rely so heavily on mortgages? Because housing is the largest store of household wealth. Because mortgages create long-term, predictable cash flows. Because real estate is politically sensitive. It's the perfect collateral. So interest rates are tuned with housing in mind, but not for your comfort, for system stability. Now, zoom even further. Interest rates influence everything connected to your home: construction, rent, property taxes, urban development, demographics. Low rates create sprawl and bubbles. High rates create stagnation and shortages. Cities are shaped by central bank decisions. Your neighborhood is a macroeconomic artifact. Now here's the uncomfortable twist. Interest rates don't just react to the economy, they create it. When rates are low, startups flourish. When rates are high, only giants survive. When rates are low, people start businesses. When rates are high, they hoard cash. Interest rates decide who lives and who dies in capitalism. And your mortgage is a tiny piece of that machinery. Now consider the future. Debt levels are historic. Populations are aging. Productivity is uncertain. Geopolitics is volatile. Central banks are trapped between inflation and debt. If they keep rates high, debt collapses. If they cut rates, inflation returns. Your mortgage will swing with this dilemma. Not because of your job, not because of your bank, but because of global macro constraints. Now, think about control. You can negotiate your mortgage. You can refinance. You can choose fixed or adjustable. But you cannot control the interest rate regime. You are renting money from a system you don't vote on directly. And that is the hidden game. Interest rates are marketed as technical numbers. They are actually social choices embedded in institutions. They decide who gets homes, who rents, who builds wealth, who falls behind. Now, here's the unresolved tension. We need interest rates to allocate capital. We need them to control inflation. We need them to stabilize crises. But they also create generational winners and losers. So here's the question that hangs over every mortgage contract. Are interest rates a neutral tool that keeps the economy functioning, or the most powerful wealth distribution machine in modern society hidden behind a single percentage point? Kindly subscribe now so you won't miss the next video.